Welcome to Taking Stock for the week ending 7th of October 2022, where myself, Tim Lincoln, and Kien, Trinh, our head of Stock Doctor Research, stream to you all things share market. And welcome back, Kien. Hope you had a great holiday with the family in Vietnam.
Yes, I did, Tim. It's great to take a break and reset, go overseas and really experience other wonders of the world. But wherever you go, Tim, the markets around the world, they behave quite similarly, been quite volatile last month.
Yeah, so you've certainly had a good break from the volatility, I'm sure. But as you say, if it happens here, it happens everywhere generally, doesn't it? The world is one big connected place in regard to equity markets. But wonderful to have you back, mate, and great to hear that you enjoyed that really good time with the family. So terrific stuff. But before we get started, Kien, we just need to remind our members that all of the information we share today is of a general nature. And of course, we haven't taken into account your personal situation and needs. And all of the data and performance figures we also share are of an historical nature and therefore shouldn't be relied upon as a guide for future performance. Well, Kien, the Australian market has enjoyed a few strong days to start the month of October, touch wood, of course, partly due to its oversold state during September, where the market got absolutely smashed, but also driven by the fact that the RBA here in Australia defied market expectations by increasing the cash rate by only 25 basis points, as opposed to the 50 basis points that the market was expecting. A lowering of global interest rate expectations, Kien, led to that sharp rise, as we just touched on, in equity markets. Here in Australia, this was appreciated mostly amongst sectors such as the retailers, listed property, and gold stocks. Some of the best performers within these sectors and our star stock universe include retailers like GUD Holdings, Adairs, and Lovisa, and REITs like Charter Hall, Social Infrastructure, and Arena REIT. Interesting too, Kien, gold miners like Perseus Mining, Gold Road Resources, and Alkane Resources have also performed well. So, Kien, for our investors out there, and members, of course, it's easy to understand how property and retail stocks are sensitive to interest rates, but why are gold stocks also rallying on the back of lower interest rate expectations?
Yes, Tim, gold is influenced by many factors, and that includes interest rates. But remember, gold is a physical asset, and it doesn't have any yield. So when interest rates rise, investors tend to abandon gold in favor of higher yield assets like cash and bonds. And this has contributed to gold's lackluster performance over the last year. But as you said, Tim, in recent weeks, interest rate expectations have moved lower, and this has helped drive a recovery in those gold prices and gold stocks.
Okay, fascinating stuff. And this could be the reason why gold has not provided a hedge to high levels of inflation and market volatility. And this hedge is particularly useful, especially over September, when the Australian equities market dropped 6.4%. So, Kien, what led to that market sell down during the month of September?
Yeah, well, Tim, there were a couple of key concerns. You spoke about the high levels of inflation, and this remains an issue globally. In the US, headline inflation is around 8.3%, while here in Australia, it's at 6.1%. And strong inflation data means central banks around the world have become more hawkish. In other words, they are prepared to increase interest rates quite aggressively until inflation is under control. And that created a concern among investors. And also rising interest rates, it reduces consumer demand and it weighs on corporate profits. And that's leading to fears of a global recession. And this was highlighted by the OECD last month when it downgraded its 2023 global growth forecast from 2.8% to 2.2%. And locally, the economic growth in Australia was also downgraded from 2.5% to 2% as well. And this downgrade also reflects the continued conflict between Russia and Ukraine, which sparked a global energy crisis. And that's also driving inflation even higher. Meanwhile, you have the unfunded spending plan in the UK, and that's caused a surge in UK bond yields, with the Bank of England now having to step in with quantitative easing to stabilise the bond markets. And the fiscal stimulus means that the Bank of England may need to raise interest rates even further down the track. That's caused a capitulation in the UK pound and also compounded fears of financial crisis, Tim. But with these risks, should investors be concerned?
Well, they're not new, are they, Kien? The risks have certainly been reverberating around the markets now for a long time. So they're certainly not new, but it's great to hear that consolidated reinforcement and reminder of what the actual risks are. But to me, Kien, and hopefully to many of our members and certainly our business, because we're very much bottom up investors and where we focus at the macroeconomic level and the company level, all of the macroeconomic indicators are purely noise to me, albeit it does have a strong concerning edge to it. And certainly we are empathetic to those that may be directly impacted, especially by the conflict in the Ukraine. However, the market volatility, and really for the past 12 months and also September, has created wonderful buying opportunities for investors, with many quality oversold star stocks rebounding strongly over the past week, which was great, but very, very short term at the same time. But wonderful to get that little bit of a reprieve. That said, until inflation and interest rates peak and stabilise, we anticipate many more bouts of volatility, especially around the time that the new CPI, inflation and interest rate data and announcements are made. But we did see that strong rebound here in Australia in stocks like information software provider Objective Corp and cooling systems designer PWR Holdings. Others like building materials company James Hardie, REA Group, and circuit board software designer Altium have rallied some 5%, which is great for our members, Kien.
Yes, Tim, another sector of the market which presented opportunities also lies within the energy space. Star stocks like Woodside Energy, Santos, and Beach Petroleum, they are benefiting after OPEC, a group of oil-producing countries like Saudi Arabia and Russia, they collectively agreed to reduce global output by 2 million barrels per day, or about 2% of global consumption from November. And many analysts are now expecting oil prices to surpass around $100 per barrel by the end of the year, with European sanctions expected to tighten Russian oil sales in December.
Wow. Volatility everywhere, Kien. But with rising oil prices sparking further inflationary pressures, we remind investors and members to stay vigilant and disciplined. Manage risk by investing in a diversified portfolio of financially healthy businesses that have strong market positions and a wide profit margin to mitigate any inflationary pressures. Look for those that have strong cash flows to manage their balance sheet debt, especially with borrowing costs on the rise. The risk of insolvency is increasing also, with the number of Australian corporate bankruptcies moving back towards pre-pandemic levels, as can be seen on the chart on the screen, which is a real concern, Kien, isn't it?
Yes, Tim, the number of insolvencies in Australia have now doubled over the last few months, and the risk is rising with higher interest rates and slower economic growth as well. So we just got to be really careful out there. But moving on to our corporate calendar, Star Income stock Bank of Queensland, they kick off the bank reporting season with its result expected to be out on the 12th of October. And the stock is currently on a gross dividend yield of 9.4% and is expected to go ex-dividend near the end of this month as well for those income investors. There's also a few AGMs releasing next week. And of course, the mining quarterlies, they don't come out in another 2 weeks, so look out for them.
And now to Under the Microscope, Kien. And this week, we take a deep look into the current state of the iron ore market, especially with investor concerns around the negative earnings revisions across our star stocks like BHP and Rio Tinto. From the chart on screen, we can see that the iron ore prices have been retreating back to levels not seen since 2019. So, Kien, what has driven the weakness in the iron ore price, and lower forecasts in iron ore assumptions?
Yes, Tim, this appears to be driven by a few factors. Firstly, Chinese steel production is slowing this year, and that's partly on the back of its property developer debt crisis. Currently, China is responsible for 60% of global iron ore demand, and that's contributing to this slowdown. In addition, you've got global demand for steel outside of China. That's estimated to fall by 5% this year due to the widespread global economic slowdown. And third, you have the supply of iron ore, which is expected to increase in 2023 due to Brazilian miner Vale's ongoing recovery.
Okay, and with earnings revisions significantly down over the last 3 months for BHP and Rio, how will this potentially impact their dividends, Kien?
Yes, Rio and BHP, they have some of the lowest costs of operations in the world, which means that despite the negative earnings revisions, the forecast free cash flow is expected to remain strong and sufficient to cover dividends. In addition, you have the gross dividend yield of around 12%, and that's well above the market, and that allows sufficient margin in case dividends were cut in the coming year.
And within this space, Kien, we also have star income stock Deterra Royalties. Its earnings have been resilient despite lower iron ore expectations. Why is this?
Although Deterra is also exposed to changing iron ore prices, being a royalty owner of BHP iron ore project allows it to benefit from the increase in near-term iron ore production volumes as well. And that's at the MAC project. And this is why the 3-month change to its earnings is fairly stable. And of course, you have free cash flows. They remain well above dividends per share, which implies the gross dividend yield of around 11% is quite sustainable for now.
But of course, Kien, you and the research team will continue to keep your eye on the heightened active risks for our members, especially given that these stocks are not traditional defensive income stocks and are more driven by commodity price cycles. On top of this, they are not expected to go ex-dividend for another 5 months. And now to question of the week, Kien. And with the banking reporting season due to kick off mid-October, our members are asking the question, with interest rate hikes, how could they possibly impact the profitability of our Aussie banks?
Well, Tim, the core of the bank's profitability comes from its net interest revenue, which represents the margin the bank generates by charging a premium rate on its loans, and that's relative to the rate it pays on customer deposits and other funding sources. Now, when interest rates rise, banks increase the rates on their fixed and variable loans, and they tend to delay increasing the rates they pay out from their customer deposits. And the other benefit comes in the form of higher returns on so-called, what they call replicated portfolios. And these portfolios allow the banks to manage their interest rate risk and are invested in government bonds, which are now paying higher rates as well. And in addition, you have higher interest rates, which lead to more expensive fixed loan rates. So customers tend to shift towards variable rates, which offer higher margins for the banks as well. In fact, analysts have estimated that the net interest margins for the bank sector could increase from 1.77% this year to 1.85% next year, and that's due to rising interest rates.
Okay, but however, interpreting this is not easy. High interest rates can be a double-edged sword, can't they, Kien, for banks, because it can lead to an increase in mortgage stress and loan repayments in arrears. It could also reduce mortgage growth, which can slow down a bank's overall revenue stream.
That's right, Tim. So we need to monitor these factors very closely. But for now, with unemployment remaining low, the risk of mortgage stress is quite minimal. Hence, we believe the bank should report solid results over the next few weeks, and they should continue to pay an attractive above-market dividend yield of between 6 to 9% in the coming year. And you can use our stock filter to compare some of these bank metrics like dividend yield and upcoming ex-dividend dates to help you make a decision on what bank to invest in.
Yeah, the stock filter and the watch list is certainly handy this time of year for the banks, but there's also other companies out there who may be benefiting from the interest rate increases too, Kien. You got any names for our members?
Yeah, within our Star Stock universe, there's Net Wealth, the ASX, and also Medibank Private. Both Net Wealth and the ASX, they earn interest on client margin accounts balances, while Medibank has an investment portfolio that is 80% weighted towards fixed assets. And also, let's not forget earnings from Genworth Mortgage Insurance as well, which is tied closely to interest rate changes. So if interest rate expectations are lower, they tend to benefit as well.
Oh, excellent stuff, Kien. And yeah, wonderful to have you back too. And glad to see your refreshed face on the screen here. And I'm sure our members are glad to see you back, even though the research team, Jason Yin and Dan, and Matty Schwartz, when he was there from the fund perspective, certainly did a great job while you're away. But great to have you back, and wonderful to see that you had that relaxing break.
Yeah, thanks, Tim.
Okay, so thanks for tuning in today, everyone. Just a reminder that Lincoln Live happens at 10:30 Australian Eastern Summertime every Monday morning. So we're back again on Monday if you choose to tune in. It's a wonderful session where we really answer your questions and regarding stocks and strategies. But just to recap on today, don't fear volatility. Obviously, if we've got to block out some of that macroeconomic noise, focus on the long term, that's critical, and construct our portfolios from high quality businesses, and just have the confidence that this period of severe volatility will pass and things will normalize, and off we go again. And yeah, so that's the main message we want to leave you with today. The volatility will be here as interest rates and inflationary figures bobble around until they normalise. Then there'll be choppy waters ahead. Take care and have a happy, healthy and prosperous week.